Welcome to Oregon Cash Flow Pro. My name is James Barber, always trying to help you maximize your cash flow. In this video, I'm going to show you why it's important to max fund your high cash value life insurance, specifically the IUL in this video. So Index Universal Life, a lot of people buy these policies and you end up getting a bad year in the market. Maybe you get little or no credit in any particular year, and you kind of lose the desire to fund the policy. Maybe you forgot why you bought it in the first place, the ups and downs in the stock market, and even with what it does in here, when we're protected from the downside, that it can cause people to make some irrational or emotional decisions that are not necessarily the best. It's really important to meet with your agent each year because they should be able to remind you what was the plan and why you should stick with it. But what I want to show you today is the actual tangible benefits of max funding your policy and how it can actually be the key to whether you're even happy with this thing in the near future and certainly down the road. Because these are amazing tools that we have inside of our financial portfolio to give us upside potential and downside protection. Now, this is one of my accounts, and you can see since 2018, this is when I started this policy, I'm earning an average of 7.51%. The credit that I've received, $9,576. I currently have about $47,000 in here. This is a good interest considering the amount of money that I have inside of this policy. Now, I continue to add to it each year. I can max fund this policy at a little over $6,000 per year, and I have every single year. So I was able to take advantage of good performance. But just because we have good performance, that's not necessarily the reason why it was important for me to max fund the policy. Certainly early on in these policies, we're going to have a much smaller amount of money than we will later on if we continue to fund these policies. Let's take a look here at one of my statements. This is my most recent annual statement. I didn't have $47,000 in here when this one came up. I had $30,000 at the beginning of this period. We put in $6,000, but look at my expenses. My expenses were a total of $883.36. The value in my account was at $30,000. I did put that in, but we won't get any credit on that until the year after I put that money in. So if we look at the $30,000, the expenses that came out over that next year equal almost a 3% expense ratio. That means most of the money in this account gets to go up when the market is up. And in this case, we made nearly $3,000 in interest. $3,000 in interest, $800 in expenses. That's a pretty nice increase. But this policy is young. We have decades ahead of us to own this policy. And the greater I fund it, the smaller these costs are in relation to my account value. This charge right here is actually only going to be this high for another couple of years, and then it's going to drop down, and it should be maybe somewhere around $300. Because during the first 10 years, the insurance company is recouping all of their expenses that they used to sell me this policy. That's this line item here, but this line also includes the load fees that I put into the policy. As long as I keep funding it, I'm still going to pay the load fees, but that's a one-time expense. So our other expenses are going to end up dropping down to be a fraction of 1% once this ends up going away. That's when we really get the advantage of the IUL. Most of the money that we're putting into this turns into cash value because the expenses are so low. And then the growth in the policy is going to be even better because most of the money in here is sitting in there waiting to grow and not just to pay expenses. Now, if there's a down year in the market and I don't get any credit, if my expense is a fraction of 1%, my account just goes backwards that year by a fraction of 1%. And we're in a position to take advantage of the market when it rebounds because there's an annual reset in these. It's the beauty of the IUL, that downside protection. We never get a loss in here when the market's down. We just get no credit. And then when the market's up, we get credits. So it's really important to max fund this. The reason I bring this up is because I was talking to somebody else today who had a policy that was started almost the same time as mine. It has a very similar amount of death benefit, except they've only been funding their policy at a $1,700 per year. Now, their policy wasn't designed quite as efficiently as mine was. And so their contract expenses were a little over $800, and their cost of insurance was another couple hundred. In total, their insurance expenses, when you add those together, were about $1,100. They're putting in $1,700 a year, which means their expenses represent over 50% of what they're putting into it, significantly more than 50%. That does not leave very much money left to turn into cash value. This person was also in the S&P 500 point to point with a cap, just like I have been, but their cash growth over the last 6 years was not very much. They've been putting $1,700 in there, and they have about $3,000 in there. I've been putting in $6,000. That's an extra $4,000 more. But I've got $47,000 in my account. It hasn't been 10 years, so it makes a big difference if you're funding it at a high enough level that the expense inside of this is minimal compared to the cash value that we're growing. So my advice to that person, max fund that policy. And the thing I try to tell everybody, if you're going to own one of these high cash value life insurance policies, the best thing you can do is to max fund it. Let's look at one more example. Actually, we're going to look at two more examples. This is a policy that I own on one of my daughters. We've been putting in $3,000 a year. This is with a different carrier. We've put in a total of $19,000 because it's my daughter's policies, and we're going to own this for the next 60, 70 years. That's a lot of compounding that's going to be able to happen. But the amount of money that's in here is going to be tiny compared to where it's going to be at in the next 10, 20, 30, 40 years. So I'm not too concerned about the returns in these early years. Because of that, we have the most aggressive index options chosen, where I pay extra to get a better potential bonus. Now, over the last few years, I've had a couple of good years, but then I've had a couple of bad years. And so I've been paying extra. I haven't quite got the payback for that, but we're still growing significant amount of cash value. And when we get that market bounce back, when we catch a nice good year, it's going to make up for those 0 years. And hopefully it'll make up for the extra that I've been paying to get that extra bonus. Let's look at one of the statements. This is the annual statement from that one. You can see the value at this point was $11,000. We added another $3,000. This is the load fee in this particular policy. So the rest of these expenses, this is what I pay for that extra bonus. We pay $135. It's 1% of the amount I have allocated to it. So our actual expenses in here are these right here. This is our insurance cost split between these two. And then we have the expense charges. Now, in a juvenile policy, they're going to recoup these charges until age 32. So it ends up being a little over 15 years in this case. But our total expenses now are about $460. Well, our value in our account was $13,000. That represents about 3.5% expense ratio. Now, if we add in the load fee, like we did with the other policy, that brings us up to about a 5% expense ratio. That's still way better than the person I was meeting with earlier today that had well over a 50% expense ratio. So even though this policy hasn't been performing very well, a lot of it has been turning into cash value. I should say it hasn't been performing well every year. We have had some good years, but it's still been turning into a lot of cash value because the underlying expenses are low in relation to the amount of money that we're putting into the policy. I'm still putting in more than that other person was putting in by about $1,500, maybe $1,400. And our expenses are very similar to theirs, but I actually have quite a bit of cash growth. Let's take a quick look back at that policy. Remember, we put in $19,000 and the current value inside of that account is over $16,000. We haven't hit our break even, but remember, we put out extra money for the aggressive growth options that have been struggling in some of the years. But that's a significant amount of cash value that can grow. If we get a 10% return, we're almost to our break even point. If we get a 20% return, we're going to get to our break even. It doesn't take but one good year to get us back on track with where we want to be on these things. Now imagine this policy 50 years down the road. In 50 years, the cost of the insurance is going to be like 0.1% of the overall value in the policy. Doesn't take very much gains to pay for that. And in fact, I could just put my money in the fixed account in that scenario. Right now, the fixed account, I could get 5.5% on this policy. I can easily cover the cost of insurance inside of these. Okay, one more policy. This is one I started last year and I minimum funded it. This policy is on my wife. And the reason we minimum funded it is because we were still finishing max funding some other policies for that year. And I started this one earlier than anticipated in order to take advantage of the automatic upgrade program when it comes to the health rating. Now, that automatic upgrade program, at that time, it was going away, but they brought it back. So if you have any health issues, as long as you can qualify for standard or better, you automatically get the top health rating. So make sure to book a meeting with me if you're interested in taking advantage of that offer while it's around this time. But let's look at the impact of a minimum fund on this same type of policy. Our expenses end up being $600, $900. This is about $1,400, almost $1,500 in expenses, which means I have about a 50% expense ratio if I just minimum fund this policy. Well, this design that I did, we could actually fund this at about $79,000 per year. If I fund it at $79,000 and the expense is $1,500, that covers the cost of insurance and the recouping of their expenses to sell me the policy. If we ignore the load fee is 5%. But if we ignore the load fee, that means this next year, if I put in $79,000, the expense ratio is going to be at 1.8% of the value in the policy. If we add in the load fee, that bumps it up to 6.8%. But that load fee is only charged to get the money into the policy. It's a one-time cost. It's not ongoing. So as soon as I get that money in, because it's so much greater than the expenses, every single year, I have the opportunity for that $79,000 to grow when the market is up. And in this policy, I have a 1% guaranteed bonus. Well, if I'd put in $79,000 next year, my expenses are going to be less than 1%. I can cover the expenses with that 1% bonus, even when the market is down. These products can be amazing when we get to that point. And this is only year 2. So in a properly designed policy that is designed to absorb a lot of cash, like this one is, if we max fund it, we're getting those expenses down immediately. Now, there's one other big benefit to this as well. All of that turns into cash value above and beyond the expenses. When I put in large amounts of money, when we're max funding this policy, that cash value is also liquid. We can borrow from that. And I do borrow from these. On this policy, you can see my cash surrender value is very low, but my accumulated value is very high. That's because I'm borrowing almost all of that money out. And the reason we're borrowing it, it's a low interest rate. I don't have any minimum payments that I have to make. They'll send me a bill for the interest, and I do pay the interest each year, but I don't have to. I could still borrow out some other money if I needed to. But remember, this is the account that I'm earning 7.5% since inception. Over this last year, I've been earning close to 9%, and we're borrowing almost all of that cash value at 4.6%. So when you see my videos on my channel where I'm doing challenges and I'm taking a loan, I'm buying something in the stock market, I'm trading options, or I'm buying a high dividend ETF and it's going to kick off dividends and pay the loan back, this is where I'm operating from. Got my money building in multiple places. And in here, as long as the expense is very low, we're going to continue to get a lot of cash value growth in here. I can borrow it from here and go put it to work somewhere else if I want to at a very low cost. And I might be getting some arbitrage between the interest rate here and what it's doing inside of the policy. But again, these policies are young. The biggest value in these is going to be 20 years from now. Who knows what the interest rate will be, but it's not going to be any higher than 6% in this policy. That's the maximum it can be. And in that other policy, the maximum charge for the interest is 5%, and it won't affect the growth in the policy. So 20 years from now, hopefully, I'll still be doing videos for you guys, and you'll be able to see much higher balances. And I may still be doing challenges where I'm borrowing that money out, putting it to work, and then using the profits from that to pay the loans back. I hope this has been educational for you. That is the point of this. Bottom line, it's really important to max fund your policies because you're going to get the best benefit from owning these when you do so. Now, if you're interested in a policy like this, or like my other one, where we can really fund it at a high level, reach out to me. Do free consultations for anybody. If you have a policy you want me to take a look at, let me know. I can advise you on the best way to utilize what you currently own. And if you have any other questions or comments, put them in the comment section below. Be sure to hit that like button and subscribe. I really appreciate the support that you guys show, and we'll see you in the next one. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.